Hello and welcome to ETNA. You're watching IPO Central and my guest today is from Amagi Media Labs. The company's IPO is opening on Jan 13th, closes on 16th, price between 343 and 361. The issue comprises of fresh issue of 816 crores and OFS of 972 crores. So a total size of nearly 1788 crores. That gives the company a valuation of roughly around 7,800 crores. And joining me today is Bhaskar Subramanian, who is the founder, MD and CEO of the company, and Vijay, who is the CEO of the company. Gentlemen, thank you very much for joining us. You are into media content business from a digital point of view. Give us a sense of the business model that you have, Bhaskar. We all are used to seeing smart TVs and videos, and I think you form the infra for those devices, I would say. Can you take us through the business model and how you have been able to scale up?
Absolutely, Sajid. I think thank you for this opportunity for us to be here. Amagi is a media technology company. We are a SaaS, which is nothing but SaaS, software as a subscription model. We provide software for TV channels, content producers, studios, news and sports producers worldwide to enable them to run their media operations on a cloud software instead of all the hardware, the real estate, the data centers and satellite distributions and OB-WANs. We're replacing all of that with a software mechanism through which they can actually run their content operations. The second one is once you create that content, you can now distribute it worldwide. We connect to 300 plus distributors of content worldwide. These are the OTT applications, connected TV applications that we connect to today in 40 plus countries where you can actually consume that content. Wherever you're consuming, we enable the technology to also advertise you actually advertise on the content and make money through that process. We are not an ad tech company, but enable the advertisers to connect to the platforms. We work only with the TV channels so that we make money for them. And we are a technology support, what we call the glass-to-glass technology, starting from the camera till the point it reaches a consumer or a viewer screen. All the different processes that happens in the factory at the back end from a content standpoint, we enable them to make it software. That's the business that we do today.
Interesting, glass to glass, that's what you're saying. But give us a sense of the kind of revenue model that you have, because you are providing cloud infra for many of the content producers, and that infra acts as a platform wherein consumers come directly and consume that content. But how does the revenue model pan out?
Yeah. Thanks for that question, Sajid. Great to be here. Our revenue model is pretty simple. Most of our revenue comes from, as Bhaskar alluded to, a subscription model, which is a recurring monthly fee that we pay, similar to how you pay for your subscriptions for various channels and other things, right? So similarly, our enterprise-grade customers, pay a monthly fixed fee per channel or per delivery. And so a good chunk of our revenues are based on that subscription model.
And how do you look at content? Because when you're talking about content producers, is it based on the kind of content and also the quantum of content that you are storing on your cloud infra? Based on that, your fees increase or decrease, and how does it vary actually?
So if you look at it from a business model standpoint, right? Our customers bring their content to the cloud first. Once they bring it, they want to prepare that content. And preparation could be if it's a live match or even a live news scene that you want to get done from a studio, or it could be just entertainment, movie channels that you're creating or any sort of genres that you're doing. We enable them to prepare the content. Could be linear channels that you create, live sports that you're producing, or a news that you're producing. All of that is the first part of our business, what we call the preparation part of the business. Once you prepare the content, you're now able to take this content to multiple different destinations. When I say destinations, these are our customers today, like every other TV channel in the world, wants to go global. So be it a Korean drama or a Bollywood content, or if it's Japanese animation, we take this content worldwide. Today, for example, our customers, we enable them to broadcast Olympics, Oscars, Grammys, all the content that we talked about in Bollywood, soccer matches, all the football that happens in EPL and La Liga. So if you look at it, these content have to go global because people are consuming this worldwide. So we enable them to distribute it. There we make money on the number of places where we are taking this content is the second step that we do. Third, where we make money is in the number of people who are watching it, which is essentially where advertising happens. We make money on the impressions. That means how many advertising impressions that we could deliver on a per user basis or a viewer basis is the third part of where we make money. Like what Vijay pointed out, the first part of the business is subscription, essentially, which is the biggest part of our business, essentially where customers for preparing and distributing content pay us on a per month basis. And for monetizing through advertising, people pay us on a volume basis and the number of impressions that we deliver today. That's the way the business model works.
Vijay, can you also take us through the cost structure for this model? Because you are a software as a service provider. But if I look at your financials for last couple of years, except for 6 months of this financial year where you turned profitable, you've been a loss-making company. So give me a sense of the kind of cost that you're incurring in your business model and how scale can over a period of time may be able to make you more profitable.
Yeah, sure, Sajid. Maybe I'll kind of answer that in 3 parts. I'll give you some headline, bottom line numbers, and then talk about the landscape of the costs and talk about how we think about operating leverage. So if you look at, I'm sure you looked at our DRHP, our adjusted EBITDA went from negative 21% 2 years to 2% last year and about 8.3% for the first half of this year. So there's been a continuous improvement in our bottom line trajectory. We also got PAT profitable in the first half of this year. So that's broad strokes in terms of headlines. But back to your more valid question on what are the different cost buckets and how they leverage, we've got 3 big cost buckets. The first one is cloud costs, which is basically our software sits on a public cloud infrastructure, and that's about 31% of our total cost. Then we have sales and marketing costs. So in different regions, you've got sales reps catering to the customers. So in the US, we've got a sales team, similarly in Europe and wherever we get revenues from. The third big cost bucket is our product and engineering teams, which are largely based out of India. So those would be the sort of 3 big cost buckets that we have. In terms of operating leverage, quickly, a good chunk of our revenues are incremental in nature. So we have something called as an ARR. So you don't have to start the year gaining those new revenues. And you must have seen a metric called NRR, which is the growth of existing customers, is almost 27%. So a lot of our growth comes from our current customers. As a result, you don't have to spend a lot on sales and marketing or even our product, which causes our bottom line sort of to kind of leverage, right? Like, so that's why we've gone from negative 21 to sort of 8% in the last 2.5 years. And that's the mental model we intend to replicate in the coming years.
And what about the exclusivity of this content? Is it available only through your platform, or a content producer can use multiple platforms to go out to the digital world?
So typically, Sajid, if you look at it, our customers use Amagi for pretty much their operations. So we are very mission critical to the whole operating environment. And I'm talking about some of the largest media companies in the world, right? We work with almost close to 45% of the top 50 media entertainment companies worldwide already. And now, if you look at these companies, when they really do anything which is mission critical, they would want to gravitate towards one company which they can work with. So largely, if you look at our operating stuff, most of our customers work with only one vendor, which is an Amagi as a vendor, so that they can actually get their whole operating, whatever service that they take from us, we would potentially be the only vendor in that particular cohort for most of our customers. And because of this, it's just very hard to operate 2 different systems, 2 different environments through which people can do things. So that is the reason a lot of our customers use us exclusively for the service that we provide and for the content and the channels, the distribution that they do. We are the only exclusive vendor for them.
Can you also take us through your advertising monetization plan which is there, because that's also one of your revenue generator. How do you generate? You spoke briefly about it. That you work with advertisers and the content players, and then you get a small portion as part of the advertising. So, what is are advertisers coming directly to your platform and buying content, or what is the kind of metrics that are used compared to a traditional, media buying or a media selling platform?
Okay. Fundamentally, Sajid, if you look at it, our customers are media content producers or TV channels. So we don't work with advertisers directly. What do I mean by that is we are a technology platform which enables personalized advertising for our customers. I'll give you an example. So assuming we are all watching a cricket match together, assuming 1 million people are watching the cricket match simultaneously, what happens in a typical stuff is where we're distributing and monetizing, when we know that few seconds before the ad break happens, we understand that there's going to be an ad break. At the back end, Amagi's technology sends 1 million requests for advertising to a lot of ad networks. This is a like of Trade Desk or a Magnite that we send it to all the ad networks worldwide to get them to bid on the advertising. We are not an ad tech platform, so we don't really do ad sales. We don't participate in the advertising economy. What we do is when an advertising has been defined or a bid has been won for every consumer, we insert that into the stream so that before you watch when the ad break comes to your home, you're already seeing an ad that's been targeted towards you as a consumer or a viewer. That's what we do today. We get paid on a per impression basis, independent of the amount of money that the advertiser pays to the content producer. We are in the business of technology, and we get paid for the technology that we are actually delivering today.
Vijay, can you also take us through your cash flows, because your cash flows have been negative. How do you plan to ensure that your cash flows from operations turn positive from here on?
All right. A fair question, Sachin. If you look at last year, I think we were obviously cash flow positive and EBITDA positive. Our cash flows are roughly 120% of our adjusted EBITDA. Normally, our business works in such a fashion that because we are an asset-light company, we don't have a lot of below-the-line costs. Your EBITDA largely flows through to cash flow. Now, like you rightly called out, this year in the first half, you see a negative sort of cash flow because those were impacted by some one-time events relating to the IPO, whether it was a buyback or the IPO-related expenses. But given the EBITDA trajectory that we've seen, and if you look at the historicals as well, you'll see that there is a big correlation between the EBITDA and cash flow. Excluding these one-off items, you'll see cash flows being in the same zip code as the EBITDA. So, that's how we think about it.
Also, a question on your employee benefit expenses. If I look at you are a tech company, but your employee benefit expenses are over 50% of your total expenses. Ideally, I should have seen tech and technology or cloud infrastructure investment should be the major chunk for you because you are providing the platform. But why employee expenses are the highest here for you?
A large part, and again, just to give you a context, right? We are a very innovation-focused company. If you look at it, R&D and technology build-out is the reason why Amagi exists in the first place, right? So if you look at it, people cost and staff cost will continue to be the highest cost element for us as a company, both the past and going forward as well, right? Because the company is building R&D and new innovations and technology. We are a deep tech SaaS company. That's exactly what we stay, right? Good news is that we are actually reducing the cost of cloud spend because the reason is which is a high gross margin business. You've already seen it at 69% is the gross margin. That essentially means is that our software is valued at 69% of the value of every 100 rupees or $100 that our customers spend today, for example. That tells you the value of the R&D and the innovations that Amagi provides to the world today, right? So to that extent, people staff cost is the critical lever for us. Obviously, given operating leverage and what Vijay talked about, it is not something that we need to increase fundamentally because we are selling to a smaller set of customers, unlike a horizontal play where they have 100,000 customers or beyond. We have typically 10,000 customers in the world that we need to really sell to. So we don't need a large sales force. Our R&D focus is fundamentally in the future. The investments we're making is all in AI today, and all of these investments are not capitalized, all our systems. So that's the reason when you look at technology cost, our technology cost is all wrapped up in the staff cost because that's where we're spending on R&D, and none of this is capitalized in the business, right? Everything is provided and expensed out every year as we kind of spend the monies, for example. So we kept it very conservative in the way we actually explore this option from a financial reporting standpoint.
And Sachin, sorry, one quick thing to add also is that, costs as a percentage of revenue have gone down as well. So that's why you're seeing the operating leverage play out. To Bhaskar's point, this is unique talent, deep tech. So we'll have to pay better than market rates to attract them. But we are disciplined about capital allocation, and that's why you're seeing the bottom line metrics kind of improve over the last few years.
And do you see that over the next few years, the percentage of staff costs or employee benefit costs will come down because that also will play out as scale goes up for you?
Absolutely right. And again, like what Vijay pointed out, for the last 2 years, you're seeing the operating leverage payout. The percentage spend on any of the parameters technically has come down over the year. Obviously, revenue goes up, the percentage of spend, the quantum of money that we spend might not really go up or go down, right? But the percentage of spend has historically come down. We see that as a trajectory going forward as well.
Bhaskar, you just turned profitable. Is this profitability sustainable over a period of time? Because if I look at EBITDA, I'm not talking about just EBITDA here, I'm talking about just EBITDA. You're still EBITDA negative in that sense. So is this profitability sustainable going forward?
Absolutely, right. So we truly believe that the sustainability exists by design of the system, Sajid. If you look at it, our operating leverage, what Vijay is pointing out, right? By definition, you are seeing our costs coming down. What you see between the adjusted EBITDA and EBITDA is the ESOPs cost. There is obviously one-time costs given pre-IPO, this IPO stage where we had to do things from an IPO standpoint. Largely, if you remove that aberration from a system standpoint, we truly believe EBITDA will eventually flow down completely to an extent. And so we truly believe that there is directionally, we are in a secular path towards profitability. And just by design, it's not like by any artificial means, but by design, the systems and the processes and the technology and the go-to-market motion has all been designed towards building that operating leverage.
Vijay,
and in first half, we were PAT profitable also. I'm sure you saw that.
I wanted to ask you about the ESOP cost, which Bhaskar mentioned just a while back. Is there going to be any spillover of ESOP cost over the next couple of years, or all the cost has been absorbed in pre-IPO?
A good chunk, we follow the Ind AS methodology. A good chunk of our issuance costs are absorbed in the first 2 years. So this year and some part of next year. But from second half of next year, we would have lapped majority of the costs.
How do you see scale up happening, Bhaskar, for content as we have seen the world moving towards digital, consumption of content? A large part of your revenues are coming from the North Americas or Americas. How do you see that evolving in countries like India?
See, 3 tailwinds for this business that we should be aware of, right? As you rightly pointed out, streaming is becoming a big part of how all our lives in terms of how we are consuming content, which I think is a very big tailwind for us as a business. 3 things drivers is, if you look at it, every media business today wants to become a software and automation, AI automated business, which is the first trend line, what we call the modernizing this whole media ecosystem worldwide by creating an operating system for the complete media business. That's the number one. Second is every media company in the world today wants to take their content and become global so that they can reach consumers worldwide. Thanks to technology in AI and others, today language translations, subtitling, culturally, we are able to now consume content, and I'm sure a lot of us are consuming Korean content or Japanese animations today, for example, or Bollywood content going global. all of this is happening because globalization is a reality in the media business. The third tailwind we're seeing is consumption through an advertising model is becoming a reality. If you look at it 3 years back when Netflix launched advertising models, you're seeing Prime becoming advertising model. So you're going to see a lot more focus on advertising, driving consumption models in the streaming part of the business as well. So these are the three big tailwinds for us. And here is where the technology stack that we provide today is serving this whole population from an end-to-end, glass-to-glass standpoint to support this together.
Interesting.
Now, is this trend anything to do with US? Not really. Obviously, it starts in the US, but we see this as a global play as we move forward.
You spoke about Netflix and Amazon here, but they also started producing their own content. So is that something which you are also going to look at?
If you look at it, I think the world is going to be a bunch of exclusive and non-exclusive content, Sujit. And we've seen this historically play out. If you look at the last few years and reports, if you look at the reports, amount of non-exclusive content is getting higher. And the reason is very logical. If you look at it, content production is very expensive. And when we talk about exclusivity of content or anything, it's exactly like a movie. A movie is exclusively only in theaters for a few weeks or maybe a month at max. Then it comes to an OTT platform or a DTH platform today, for example. And then eventually available in many more platforms, for example. So exclusivity is a definition in the media business which is time window based, for example. So we are seeing more and more content which are exclusive becoming non-exclusive. And why is it happening is because your content production cost is so high that you want to monetize it in as many locations, in as many languages, in as many geographies that you can go to. And that is the biggest driver for us from a business standpoint of bringing content from exclusivity from multiple different studios and taking it worldwide so that this content is available for everybody. So that's the direction that we see as a secular direction that's happening across the industry.
Well, gentlemen, it was a pleasure talking to you today. Amagi Media Labs, the IPO is opening on Jan 13, closes on 16. 343 to 61 is a price band. Total IPO size 1,788.6 crores. And the company is valued at little over 7,800 crores. Thank you very much, Bhaskar and Vijay, for joining us today on ET Now and being on IPO Central.